The market is closed for Plug Power Inc. as of the last trading session on December 3, 2025, when the stock closed at $2.11 per share. This represents a significant price point, not because of the daily movement, which was fairly contained within a $2.07 to $2.25 range, but because of what it didn't do. The widely held expectation for Plug Power, especially among the more skeptical retail crowd on platforms like X and Reddit, was that the recent financing news and the continuing macroeconomic pressures would have driven the stock firmly below the $2 mark, potentially even testing the 52-week low of $0.69. The reality is that the stock is displaying a surprising level of price stability right around this $2.11 level, backed by a volume of over 104 million shares, which is only slightly below its average. This stability, in the face of what many perceive as constant bad news, specifically the perceived blow of pausing activities related to the $1.7 billion Department of Energy loan guarantee due to changes in administration support for clean energy, is the critical insight that investors need to grasp right now. The market is not collapsing, and in fact, some institutional players are using this area as an accumulation zone, suggesting a divergence between the emotional retail narrative and the quiet, calculated institutional activity. The common understanding of Plug Power revolves around its position as a pioneer in the hydrogen economy, specifically in designing and building the end-to-end ecosystem for green hydrogen production, storage, and use in fuel cells for material handling, which is its bread and butter. The prevailing narrative is one of a growth stock that has failed to deliver consistent profitability, a company constantly expanding operations that unfortunately burns through capital at a concerning rate. The expectation is that every piece of good news, like the recent NASA contract or the partnership with a major U.S. data center developer to explore auxiliary and backup power solutions, is immediately offset by the reality of financial struggle. The Q3 2025 net loss of $363.4 million on only $177.1 million of revenue, for instance. However, this is where the deeper analysis challenges that common ground. The reality is that Plug Power has been aggressively executing a series of strategic maneuvers to stabilize its balance sheet, moves that were likely undervalued by the broader market. They successfully raised nearly $400 million in debt financing, which allowed them to eliminate high-cost debt and fully fund their current business plan, a plan they project will lead to positive EBITDA next year and overall profitability by the end of 2028. This capital raise, while causing temporary dilution fear and subsequent stock price volatility, bought them time and flexibility, which is a massive, tangible win that the market's simplistic, unprofitable growth company label tends to overlook. The focus must shift from the losses of today to the construction of tomorrow's infrastructure, which is capital-intensive by nature. Looking at the immediate stock movement, we see this battle between narrative and fundamentals play out. The stock's dramatic run-up to its 52-week high of $4.58 earlier in the year was fueled by the excitement over federal incentives and capacity expansion news, but the subsequent decline, dropping the stock by nearly 50% over the last few months, was primarily driven by two things: the disappointing Q3 results and the continuous pressure from an aggressive short community. Daily trading volume has remained high, consistently in the nine-figure range, which is indicative of a massive tug-of-war between the long-term believers and the profit-taking bears and short sellers. Institutional activity, as of the most recent filings, tells an interesting story. While there has been churn with both increased and decreased positions, major institutions like Vanguard and BlackRock still hold significant stakes, collectively holding hundreds of millions of shares. Notably, Goldman Sachs Group Inc. increased its position by an eye-watering amount in Q3 2025, which suggests a belief in the long-term strategic execution that counters the negative news flow. This institutional conviction, even if complex, provides a significant stabilizing force at current price levels, acting as a crucial line of defense against panic selling. Now, let's address the short-selling awareness that is so critical in this stock. Plug Power has been a prime target for short sellers for a significant period. The latest available short interest data is staggering, with over 305 million shares sold short as of the last reported settlement date, representing a very high percentage of the float, around 23.31%. This level of short interest is a flashing red signal that short firms believe the fundamental reality of mounting losses in cash burn will ultimately drag the stock lower. Their thesis is simple and powerful. The hydrogen market is nascent, costs are high, and the company's need for constant capital raises will perpetually dilute shareholders and cap the stock price. The days-to-cover ratio, while fluctuating with volume, is currently sitting at approximately 3.82, which is high enough to indicate that if a major piece of positive news hits, the short sellers could face a volatile scramble to close their positions, leading to a quick spike. Actionable insight here is crucial. Investors should monitor the borrow fee rates, which, while low compared to meme stock highs, are a cost of doing business for short sellers. A sharp, sustained spike in the borrow rate would signal increasing scarcity of shares to short and mounting pressure. Currently, the rate is stable, but monitoring the short interest report due out next week will be key to understanding the level of sustained short conviction. We have also seen fails to deliver data spike recently, which is a technical sign of potential stress in the settlement process, often associated with heavy shorting, though it's not an automatic trigger for a squeeze. Retail sentiment is polarized, as evidenced by the discussions on forums. On one side, you have the deeply skeptical contingent, openly calling the stock a junk or scam, and pointing to the perpetual dilution, a sentiment that gains traction with every capital raise announcement. They see the $375 million convertible notes offering, which caused a recent slump, as a destructive cycle. On the other hand, you have the true believers, the hydrogen is the future crowd, who see the low stock price as a gift and use every dip as an opportunity to average down, often referencing the massive total addressable market of the electrolyzer and fuel cell industry. This internal retail conflict keeps the stock highly volatile and makes the short seller's job easier as they can exploit the lack of coordinated buying conviction. What's your take on the rising short interest? Smart money or manipulation? The core business of Plug Power is centered on hydrogen, an element often hailed as the clean fuel of the future. The company is primarily a provider of turnkey hydrogen and fuel cell solutions, notably in the material handling sector, where its GenDrive fuel cells power forklifts for giants like Amazon and Walmart. But the real potential, and the expectation versus reality tension, lies in the company's aggressive expansion into green hydrogen production and electrolyzers. The expectation is that this build-out will take too long, cost too much, and struggle against cheaper fossil fuels. The reality, however, is that Plug Power has been aggressively executing a series of strategic maneuvers to stabilize its balance sheet, moves that were likely undervalued by the broader market. They successfully raised nearly $400 million in debt financing, which allowed them to eliminate high-cost debt and fully fund their current business plan, a plan they project will lead to positive EBITDA next year and overall profitability by the end of 2028. This capital raise, while causing temporary dilution fear and subsequent stock price volatility, bought them time and flexibility, which is a massive, tangible win that the market's simplistic, unprofitable growth company label tends to overlook. The focus must shift from the losses of today to the construction of tomorrow's infrastructure, which is capital-intensive by nature. The near-term future outlook for Plug Power hinges entirely on execution against the Project Quantum Leap strategy, which is designed to improve margins and cash flow. The key catalysts to monitor are the final investment decisions and progress on the large-scale green hydrogen plants, the continued traction in the electrolyzer sales, which saw $65 million in Q3 2025, a 46% sequential increase, and, crucially, the first signs of gross margin improvement. Risks are obvious and abundant. Continued inflationary pressure on construction costs, delays in plant commissioning, and perhaps most importantly, the unpredictable political winds concerning clean energy subsidies and tax credits. The expectation is that the stock will remain round-bound between the recent lows and the $3 resistance level. The reality is that if the company hits its Q4 2025 milestones,